The most popular image of stocks is that of the stock chart. It presents a lot of information in a particular way. However, the average person might not be able to distinguish what is important and what isn't. When you turn on CNBC or look at Google Finance, you'll see something like this. The most important item is the blue line across the entire screen. This is the stock's price. You want to see it moving up and to the right. That means everything's going well. The horizontal axis of the graph is the date. More recent dates are to the right and older dates are to the left. The vertical axis is the price level. Lower prices are at the bottom and higher prices are at the top. Now you know the basics. When you look at a stock chart, here's what to look for. First, look at the general trend over the past year. This will give you a quick barometer of the firm's health and the volatility of its prices. If you see large ups and downs that form V-shapes, as noted by the arrow, then you know investor sentiment quickly changes on this stock. If the ups and downs are more gradual, then you have found a more stable stock. Next, look for the largest spikes, or V-shapes. These indicate an important event. Before investing in a stock, it is important to know what happened during the event and how it might influence the firm's future. It may be worth it to compare a competitor's stock chart to see if the event affected the entire industry or even the entire market. For example, almost all stock charts show a distinct downward spike around September 2008. After reviewing the stock's price history, it gives you a basic idea of what to look into regarding the business. It helps serve as a launching point for further analysis.